Fed speech pre-event scenario analysis for Euro USD and Sterling trading strategies. Welcome back to our Friday pre-event scenario analysis series. If you've watched our first video on gold, you already know how critical this upcoming Fed keynote speech is for global asset pricing. Today, we're shifting our full attention to the major European currency complex, focusing on two of the most liquid, widely traded pairs in the entire Forex market, EURUSD and Sterling. Before we jump into the three core trading scenarios, let's lock in the exact live market pricing and official reference rates to ground our entire analysis. Right now, EURUSD is trading firmly at 1.1650, posting a mild downside correction through the session, while Sterling is holding near flat price action, hovering right around 1.3596. For official institutional reference, the latest European Central Bank Euro reference exchange rate prints at 1.1367, and the Banque de France's official fix from August 27 sits at 1.1664, which means current spot pricing is nearly aligned with institutional fair value heading into this high-risk event. Now, let's talk about the real underlying market theme that's going to drive all big moves after the Fed speech, and that theme is monetary policy divergence. We currently have three major central banks moving at completely different policy paces. The Federal Reserve remains highly focused on sticky inflation and is retaining a tightening bias. Meanwhile, the European Central Bank is gradually shifting toward a pause and assess mode, and the Bank of England is stuck in a tough spot, still battling persistent UK inflation pressures while facing slower economic growth. This policy gap is already keeping the US dollar supported against European currencies, and every single nuance, every subtle tone shift from Fed Chair Kevin Warsh's Jackson Hole address is going to reshape market expectations for future rate differentials. That means this speech will directly control the short-term trend trajectory for both the euro and the British pound over the next 48 hours. If we take a step back and look at pre-event market conditions right now, we can see extremely typical pre-Fed price behavior playing out perfectly. European currencies are locked in a mild, muted corrective state, with no strong trending momentum in either direction. The US dollar index is trading steady and resilient across the entire G10 currency board, with all major pairs confined within a tight 0.12% daily trading range. Volatility has completely dried up ahead of the event, with both EURUSD and GBPUSD stuck inside a tight 40-pip intraday range. This is classic pre-news compression. Markets are unwilling to make any large directional bets before receiving clear policy guidance. But this low volatility compression phase always precedes a major volatility expansion. Once the Fed's official tone lands, all this trapped liquidity will trigger sharp, amplified breakout moves across European FX. In this video, we're going to break down three fully fleshed out Fed scenarios, hawkish, neutral, and dovish, and walk you through precise, high-probability entry zones, stop-loss placement logic, and target levels for both EURUSD and GBPUSD. Let's dive deep into the full actionable analysis. We'll start with the most supportive scenario for the US dollar, a hawkish Fed tone. If Warsh uses this high-profile Jackson Hole platform to double down on persistent inflation risks, explicitly push back against market pricing for early rate cuts, and reinforce the Fed's higher-for-longer monetary policy stance, the entire market will reset rate expectations in favor of a stronger dollar. Keep in mind, the July FOMC minutes already established a solid hawkish baseline, emphasizing that inflation remains elevated and policy needs to stay restrictive. If Warsh reiterates those same hawkish messages today, the policy divergence between the Fed and European central banks will widen dramatically, lifting U.S. Treasury yields and boosting the dollar's yield advantage against both the euro and sterling. For euro to US dollar, this hawkish outcome will clearly invalidate the current mild corrective bounce and accelerate bearish momentum to the downside. We expect a clean, decisive breakdown below immediate short-term support at 1.1620. Once that level gives way, market participants will begin pricing in sustained USD strength, which will keep the euro under consistent passive selling pressure. The next logical downside target zone sits between 1.1580 and 1.1600, a key structural support zone where previous buying interest emerged. In this hawkish environment, Bullish retracements for EURUSD will be shallow and unsustainable, with every bounce offering a new shorting opportunity. Our primary trading strategy for EURUSD in this scenario is counter-trend short selling on corrective bounces. We don't chase breakdowns blindly. We wait for high-quality risk-reward entries on retracements. Look for price to rally back into the 1.1680 to 1.1700 resistance zone, where sellers previously stepped in. Once price reaches this zone, wait for clear bearish rejection candle signals, such as bearish engulfing patterns or shooting star setups, to confirm selling pressure. After confirmation, initiate short positions. Place your stop loss safely above the structural resistance at 1.1720 to filter out noise, and target the key support zone from 1.1580 to 1.1600 for your primary profit exit. For more aggressive momentum-focused traders who prefer trading breakouts rather than waiting for retracements, we have a secondary breakdown strategy. Once EURUSD breaks, and, most importantly, closes firmly below the 1.1620 short-term support level, that confirms bearish momentum acceleration. You can enter short immediately on the breakdown close, set a tight risk-managed stop loss at 1.1650, and take initial profits at 1.1580. If selling momentum continues to strengthen after the breakdown, you can extend your downside target further down to 1.1550 to capture the full bearish impulse wave. Shifting over to sterling's under the same hawkish Fed scenario, we see a key difference in price behavior compared to euro dollars. While the Bank of England's ongoing hawkish policy expectations and UK inflation resilience provide an underlying fundamental cushion for sterling, preventing uncontrolled collapses, overwhelming US dollar strength will still act as the dominant short-term market driver. Sterling will reverse firmly off its flat pre-event consolidation levels, abandoning its range stability to pull back and test critical structural support at 1.3550. Any short-term bounces during this period will be weak, shallow, and completely unsustainable, with sellers stepping in rapidly on every minor rally. Trading GBPUSD shorts requires more nuanced risk management than EURUSD shorts, purely because of the Bose hawkish buffer. We want to avoid premature stop-outs from minor sterling retracements. The optimal short entry zone sits between 1.3620 and 1.3640, a proven resistance area where bullish momentum consistently fails. Enter short on bearish rejection at this zone. Place your stop loss above the recent consolidation high at 1.3680 to accommodate the pair's higher volatility profile. Your primary take-profit target is the critical 1.3550 support level, and if broad dollar strength continues to intensify throughout the session, you can extend your secondary target down to 1.3500 for additional downside gains. We also have a secondary relative value cross-play opportunity on euro sterling for advanced traders. Due to the Bose more hawkish positioning relative to the ECB, sterling generally holds its value better than euro during dollar strengthening episodes. This means in a hawkish Fed scenario, euro and sterling tends to drift gradually lower as euro underperformance takes hold. That said, this is a lower conviction trade. If the Fed delivers an extremely aggressive hawkish surprise, both European currencies will sell off sharply in unison, keeping the crosspair stuck in a tight range. For that reason, we always recommend prioritizing direct USD directional trades over crosspair plays for higher reliability and cleaner price action. Moving into the second scenario, a neutral Fed tone. This is the middle ground, balanced outcome where the Fed delivers no clear hawkish or dovish bias. Warsh will acknowledge gradual progress on inflation cooling while reiterating data-dependent policy flexibility, keeping all near-term rate options on the table. This balanced messaging will stabilize the US dollar index entirely, removing Fed-driven directional pressure from European currencies. With no fresh policy catalysts from the US, EURUSD and GBPUSD will fully decouple from dollar sentiment and begin trading purely on their regional fundamentals, European and UK economic data prints, and local institutional market flows. Under these neutral conditions, euro to US dollar will lock into a tight, sustained consolidation range, trading consistently between major support at 1.1580 and major resistance at 1.1700. There will be no strong, sustainable trend in either direction, and any intraday breakout attempts above or below the range boundaries will lack meaningful follow-through. All future trending moves will be entirely dependent on upcoming Eurozone inflation data and growth prints to validate direction. This is a pure range-bound, mean reversion market environment. The most disciplined and consistent strategy for Euro to US dollar here is structured range swing trading. The core rule is simple. Buy extreme dips near the 1.1580 support zone and sell extreme rips near the 1.1700 resistance zone. Because volatility is suppressed and false breakouts are frequent, we use tight 25 to 30 pip stop losses to avoid unnecessary range whip-out losses. We also target conservative 40 to 50 pip profits per trade to lock in reliable returns without overexposing capital. Most importantly, we keep position sizes modest and avoid overleveraging. Neutral low volatility markets offer no strong momentum edge, so overtrading is the biggest risk here. For the majority of retail traders, a patient wait-and-see approach is also extremely viable in this neutral scenario. Without a clear directional catalyst from the Fed, all directional breakout trades carry elevated unnecessary risk. The highest probability setups only occur when price pushes to the absolute extreme edges of the established range, creating overbought or oversold short-term conditions. Outside of those extreme levels, the best trade is often no trade at all. Staying on the sidelines preserves trading capital for the high-conviction breakout setups that will arrive once clear policy guidance emerges. GBPUSD demonstrates significantly stronger resilience than euro dollars during neutral Fed conditions, and this is a critical market distinction you need to understand. Thanks to the Bank of England's persistent hawkish stance and ongoing commitment to our favorite high-probability strategy for GBPUSD in this scenario is structured dip buying, which aligns with the pair's underlying fundamental strength. We look for long entries on pullbacks toward the solid 1.3550 support zone, where institutional buying interest consistently emerges. After bullish price rejection confirmation, enter long positions. Place your stop loss securely below the support base at 1.3520 to eliminate downside noise, and target the upper range resistance at 1.3650 for clean, intraday profits. This strategy leverages the Bose policy cushion against muted, range-bound dollar strength. Advanced traders can also execute a market-neutral spread trade to isolate relative strength, eliminating pure dollar directional risk. The setup is simple. Go long sterling USD and short euro USD using equal notional position sizes. Since GBP retains stronger fundamental support while euro remains more vulnerable to regional growth concerns, this spread trade captures sterling's consistent relative outperformance in choppy, directionless market conditions. It's the perfect strategy for neutral Fed environments with no clear broad dollar trend. Finally, we cover the third and final scenario, a dovish Fed tone. This is the dollar weakening, risk-friendly outcome where Warsh signals a slowdown in monetary policy tightening, acknowledges that U.S. inflation has entered a sustained cooling trend, and opens the door for potential future rate adjustments. This type of dovish forward guidance will rapidly fade market rate hike expectations, trigger broad profit taking on accumulated U.S. dollar long positions, and create a favorable tailwind for European currency appreciation. For euro to U.S. dollar, a dovish Fed trigger will ignite strong, sustained bullish rebound momentum. The pair will break decisively and convincingly above short-term resistance at 1.1700, invalidating all recent bearish correction structures. With U.S. Treasury yields falling and the U.S. dollar weakening across the board, EURUSD will extend its bullish impulse to target the next key resistance zone at 1.1750 up to 1.1780. This bullish move will have far more follow-through than the minor bounces we saw in hawkish and neutral scenarios. For conservative, risk-focused traders, we recommend patient pullback buying instead of chasing breakouts. After the 1.1700 resistance level is broken, that zone flips from former resistance to dynamic new support. We wait for price to retrace and retest the 1.1680 to 1.1700 support zone, then enter long on clear bullish rejection signals. This value entry approach delivers superior risk-reward compared to breakout chasing. Place your stop loss safely below the support zone at 1.1650 and target the 1.1750 to 1.1780 resistance range for optimal profit potential. For momentum traders who prefer trading sustained price acceleration, we deploy a breakout continuation strategy. As soon as EURUSD clears the 1.1700 resistance level with strong volume confirmation and solid bullish closing candles on the higher timeframes, we enter long immediately. We use a trailing stop to lock in incremental gains as momentum extends, set an initial take-profit target at 1.1750, and extend our target to 1.1780 if bullish momentum remains strong and consistent post-breakout. Once again, sterling USD outperforms EURUSD substantially in a dovish Fed environment, and this is the key takeaway for this entire scenario series. Thanks to tighter UK inflation prints and a more aggressive Bank of England policy stance, sterling possesses far stronger short-term price elasticity and rebound sustainability. While the euro rallies on dollar weakness, sterling USD will unlock more flexible, steady, and powerful upward momentum, breaking above its intraday flat resistance to test the 1.3650 to 1.3700 key resistance zone. Our post-long strategy focuses on high-quality pullback entries to avoid overpaying for momentum. We look for mild, shallow pullbacks into the 1.3600 to 1.3620 support zone, which is the breakout base for the bullish rally. Enter long on bullish confirmation. Place your stop loss below the structural support at 1.3570, set your initial target at 1.3650, and extend fully to 1.3700 if bullish momentum accelerates. The bow's inherent hawkish bias acts as a powerful secondary tailwind, amplifying gains during Fed dovish pivots. To capitalize on the clear performance divergence between pound and euro dollar, advanced traders can run a relative value outperformance spread trade. Go long GBPUSD and short EURUSD with equal position sizing. This trade isolates the fundamental strength of sterling versus the euro's more muted rebound potential. Our target for this spread is a 50 to 80 pip outperformance gap, capturing sterling's superior rally quality in a dovish Fed market. To wrap up this full pre-event analysis, let's recap the most important takeaway you need to trade this event successfully. Fed policy tone is the single dominant catalyst that will dictate all short-term European currency price action. Across hawkish, neutral, and dovish scenarios alike, sterling USD demonstrates far stronger fundamental support thanks to sticky UK inflation and a more proactive Bank of England. This makes sterling the most resilient, most consistent, and most tradable European pair heading into this critical Fed speech. That covers our complete scenario breakdown and actionable trading strategies for euro-dollar and sterling. Stay tuned for the third and final episode in this three-part pre-event series, where we shift our focus to classic safe haven currency pairs, USD Japanese yen and USD with Swiss francs, delivering full scenario analysis and exclusive event day trading strategies.